Imagine you're planning to buy your dream home, but you need a loan to finance the purchase. You visit a bank to discuss your options and suddenly find yourself overwhelmed by all this financial jargon, like down payment, collateral, interest rates, and loan terms. Don't worry, we've got you covered. In this video, we'll explain these terms and concepts so you'll be better prepared to make informed financial decisions. First, let's define a down payment. A down payment is money that you pay towards a purchase when you first take out a loan. Let's say you want to buy a shiny new car, but you don't want to pay for it all up front. Before you drive off the lot, you'll need to take out an auto loan to complete the purchase. When applying for the loan, the lender may ask you for a down payment to show a vested interest in the purchase of the car. This vested interest ultimately reduces the risk to the lender. Another way the lender can reduce their risk is by using collateral. Lenders can issue loans that are tied to a specific asset like a house or a car. These are known as secured loans, and the asset being used to secure the loan is considered the collateral. In this case, if you don't keep up with payments and default on the loan, the lender can repossess the asset to recover some of their money. On the other hand, lenders can also issue unsecured loans that don't require any collateral. Examples of these include personal loans or student loans. These can often come with higher interest rates due to the increased risk for the lender. Now let's talk about loan terms. Loan terms refer to the contractual agreement between the lender and the borrower. Usually these terms include the repayment period, the interest rate, and any additional loan fees. The repayment period outlines the schedule for you to pay back the loan. A shorter repayment period usually means higher monthly payments but lower overall interest paid when compared to a longer repayment period, which often results in lower monthly payments but higher overall interest paid. The interest rate is the cost of borrowing money, expressed as a percentage of the principal or loan amount. There are two main types of interest rates, fixed and variable. Fixed interest rates remain constant throughout the life of the loan, while variable interest rates can change over time based on market conditions. The lower the percentage, the less your interest costs will be. When reviewing your loan terms, it is always a good idea to understand any fees associated with a loan and check for other terms that can be built in, such as prepayment penalties, balloon payments, or interest-only periods. A prepayment penalty can occur when you decide to pay a loan off earlier than the original loan terms outlined. This penalty can be costly, so it's important to check for one before you pay a loan off early. Sometimes it helps to have payments lower during the beginning of a loan period. A balloon payment can keep your loan payments low up front, but can lead to a large payment later that will need to be planned for. Alternatively, an interest-only period can also keep your payments lower up front by avoiding payment towards the principal of the loan until a later date. This may be helpful depending on your situation, but you should consider how an interest-only period impacts your total interest costs over the life of the loan. Now that you understand these critical concepts, you can make more informed decisions when it comes to borrowing money. Remember to compare different loan options, taking into account their loan terms. By doing so, you'll be better equipped to choose the right loan for your needs and financial goals.